What is your opinion on the current state of the market and its pricing for the year end? Specifically, the January Fed funds contract stands at 440, 439, indicating a 75 basis point difference for the entire year. Do you find this worrisome, and if so, what factors do you believe contribute to the difference?
You know, I've been really wondering about this for a long time because, in my world, inflation is not going to come down very quickly. And in that regard, then cutting rates doesn't really fit into that scenario. So, the markets, I think, have been pretty optimistic about how easily inflation will respond to our policy. Honestly, I hope I'm wrong and they're right, because that'll mean that the economy is in balance sooner than later. But it's not my baseline case at all. I try not to speak for the markets. What I would say is, even in my building, there is a lot of debate about how strongly our policy is going to bite on the economy. Some think it's actually going to bite really, really strong and come down fairly rapidly. But our fairly rapidly is not even as rapid as the markets are. So my baseline case is we won't really be thinking about cutting till well into 2024. I think what we're going to see is just an orderly decline. I'm hoping that we see what we've seen over the last several months, where inflation has come from a very high level to now it's just a high level. But even if you look at most measures of inflation, they're still 2 times where our target is. And so there's a long distance still to go. If I had a bias between going up and going down as our next action, I would say we might have to go up. Right. What we've seen is that inflation has been persistently high. Consumers have been really resilient in terms of their spending, and labor markets remain extremely tight. All of those suggest that there's still going to be upward pressure on prices. Now, that's not my base case either. For about 6 months now in the dot plot, this is the level I want us to get to, and now we can wait and see. But if there's going to be a bias to action, for me, it would be a bias to increase a little further as opposed to cut. And I go around and talk to lots of folks. They all tell me the labor market is easier for them today than it was 12 months ago, which suggests that there is some easing that's happening in the labor market. Now, it's not happening super fast, and we still have a lot of dynamics in the pandemic that are affecting labor force participation in segments of the economy. But I do think there's been progress. There's definitely been progress on inflation. And, for me, I think we've done, if you think about this, the easiest part of inflation reduction. Right. Now it's going to take some time to work through the services. Goods are going to still stay somewhat volatile. One thing I would say that's very encouraging to me, when you look at the CPI report that came out last week, less than 50% of the items in the basket now are showing 5% increase.
Do you share the concern that when inflation remains consistently high, around 4.5% to 5%, consumers and businesses may adapt to it, leading to a situation where businesses raise prices and consumers start demanding higher wages, thereby further raising concerns?
Of course. I mean, if inflation expectations really become unanchored from the levels that we want it to be, then everyone's behavior changes, and it can almost be a self-fulfilling prophecy. Now, fortunately, as we do our surveying of businesses and my conversations with bankers and just regular families, they all tell me that they understand that this is still a very short-run episode, and that they're not expecting the long-term reality to be at this level. There's still a lot of confidence that our policies are going to be able to get inflation back down to our 2% target. And to be fully clear, we're going to do all that we need to make sure that happens.
Considering that we have already reached a level of 5% to 5.25%, and there might be additional tightening of 50, 75, or even 100 basis points from the financial sector, why doesn't that make you reconsider whether we have already reached the desired target? Why don't you think that further action may not be necessary if these factors are taken into account?
I'd say 2 things on this. So first, I don't really do that calculating like how much bank action translates into Fed funds rates. I think there are a lot of implicit assumptions there that makes that a really difficult exercise. But the second thing I would say is, when we raised rates, my expectation was that financial conditions were going to tighten. The crisis did that on some level. Now, I would have hoped that the financial conditions tightened in a somewhat more orderly fashion. But we're seeing the tightening that needed to happen, and now the question is, how much is that really going to bind on activity? In my baseline case, I think it will continue to slow down the economy, but it's not going to be in big chunks. I think this is going to be a gradual thing over an extended period of time, and that's why I think the appropriate policy is really just to wait and see how much the economy slows from the policy actions that we've done.
President Bostic expresses his view that cutting rates may not be suitable in the current scenario, as he believes inflation will not decline rapidly. He mentions that the market have been optimistic about how inflation responds to policy, but he hopes they are right and the economy balances sooner. He indicates that his baseline case does not involve considering rate cuts well into 2024. He acknowledges the market's pricing for the year end as indicated by the January Fed funds contract, noting the 75 basis point difference, and raises a question of whether it is worrisome. However, he does not explicitly explain the reasons behind the disconnect between market pricing and his own outlook. He emphasized that inflation has been persistently high and factors such as resilient consumer spending and tight labor markets suggest upward pressure on prices. While he does not indicate that increasing rates is his base case, he mentioned that if there was a bias towards action, it would lead towards rate increases rather than cuts. Looking at the labor market, stating that while there has been progress, it is not happening rapidly due to the lingering effects of the pandemic. Also acknowledging progress in reducing inflation, but mentions that it will take time for it to work through the system, particularly in the services sector. He also sees the concern that if inflation remains at elevated levels for an extended period, it could lead to a change in behavior among consumers and businesses, resulting in a self-fulfilling prophecy. He highlights the importance of anchoring inflation expectations and expresses confidence that policies will bring inflation back down to the 2% target.